Hello, and welcome to the November Market Update webinar. My name is Dan White, one of ARK's associate portfolio managers, and I will be moderating today's call. This call was pre-recorded on November 14th, 2025. With that, I will now turn it over to ARK's CEO and CIO, Cathie Wood. Cathie?
Okay, thank you, Dan, and thank you everyone for joining us. Well, the markets, at least as of this recording, are in a bit of turmoil. And you'll get a full explanation on In the Know, which I did last Friday. But the summary here is we are in a bit of a liquidity squeeze. We think it's temporary. There are three reasons. One, we've seen the Fed, as of the last meeting, not end quantitative tightening. Many people expected them to do it at the last meeting. We think they will do it at the next meeting, so that's December 10th. The second liquidity squeeze is related, and hopefully we can say now was related to the Treasury general account. When the government was shut down, the Treasury's cash balances were building. They were not dispersing the cash. The government shutdown is over. It's going to take a little bit of time to ramp and get everything back to normal. But we think that source of a liquidity squeeze is behind us. And now we're dealing with the third, and it really has to do with interest rates. Will they continue to come down? The market had been thinking, yes, they would, and we'd get another cut in December. We think we will get another cut in December, and that the Fed will shift from what seems to be a hawkish tone right now back into a more dovish tone as we approach that date. We're seeing inflation really come down significantly. Maybe we don't have the government statistics, but we do have the bond market, which is helping us understand that as measured by the 10-year Treasury yield, the inflation expectations have been coming down for the last few months. We're in roughly the 2.5% range on that metric. Same is true for Trueflation, which is a real-time indicator, 10,000 items monitored, 10,000, tens of thousands, I think it is, monitored in real time. And that metric is at roughly 2.5%. Now, it was down to roughly 1.5%, has come up here. Tariffs, of course, are a big reason. We think tariffs are going to wash through as well, and some may even come down. I think the administration is taking the election results, New Jersey and New York in particular, as a significant warning that if affordability does not continue to improve, the midterm elections are going to be very difficult for at least the Republicans. We're seeing other metrics, though, that suggest that affordability is going up. One of those is oil prices. West Texas Intermediate cracked $60. And there are cyclical and secular reasons for oil prices to continue falling. Housing prices and shelter in the CPI is roughly 40% of the CPI. Housing prices, new home prices have been falling for roughly a year. Existing home prices or home price inflation is down to 1.5%. And that will get into the CPI over the next year. And then finally, we're seeing a lot of technology indicators, and this is our bread and butter. The metrics we follow and the original research we do suggest that the undercurrents of deflation associated with new technologies evolving are building. And we would not be surprised to see a real break in inflation once the tariffs have passed through in the next year. Now, the burden of proof is on us. I've just given you three indicators that suggest inflation could come down significantly in the next year. But it has been stuck for the last year in that 2.5% range, give or take a little. So we think it will resolve on the low side of expectations. We're surprised at what the Fed is saying right now, the various Fed governors, especially because the employment indicators are weakening significantly. Sure, we don't have the government employment indicators, but ADP is out, and month after month now, they are saying that employment is either contracting or expanding very, very slowly. And we're also seeing new graduates. That unemployment rate is increasing more rapidly than any other cohort's unemployment rate. And I think the duration of unemployment for everyone is approaching 30 weeks. So these are indicators that suggest that the velocity of money it has already flattened out, and we think it will go down on a year-over-year basis. M2 right now is up 4.8%. If the velocity of money falls on a year-over-year basis, that means nominal GDP will probably drop below 4% or 3%. And nominal GDP includes both real GDP and inflation. So the combination at 3%, something's going to give. And right now, it seems like the real side of the economy is starting to capitulate, as measured by labor, at least. As productivity increases, maybe it won't hit the real growth line, but it is hitting labor, and of course, inflation would be the other give. So we think this liquidity squeeze will pass as the government opens fully, as quantitative tightening ends, and as interest rates continue to come down in response to weakening employment and inflation indicators that are pointing down. So with that, Dan, take it away.
Thank you, Cathie. We'll now begin the question and answer portion of today's webinar. Questions were received from our clients, our distribution partners, and sent to our Funds X account and Instagram account at ARK_funds. Cathie, so I'm going to come back to you on the first one here. No surprise, we got a lot of questions on this. It's the topic of discussion this month on every media outlet. So just, Cathie, are we in an AI bubble?
I love this question. And the reason I love it is many people are worried about that risk out there. And this, in comparison to what was going on in the tech and telecom bubble, is night and day. In the tech and telecom bubble, sure, you had some value investors saying this doesn't make sense. No one was listening to them. And you had growth investors just throwing money at the dream back then. The seeds that were planted in the 20 years that ended in the tech and telecom bubble have been germinating for the last 25 to 30 years. Back then, the technologies were not ready. The costs were way too high. We didn't get the cloud until 2006. We didn't get the first real breakthrough in AI until 2012, deep learning, and then the even bigger breakthrough in 2017, that was transformer architecture. And of course, we had the ChatGPT moment as in late 22. We think this AI story has just begun. We are in the first inning. And the only thing that I will flag as a nuance and is related to an MIT research paper that came out on this topic a few months ago, basically saying corporations aren't seeing any productivity gains because of AI. This is completely elusive. It is a bubble, and the only nuance here is for enterprises to restructure and transform completely, which they will have to do in this new age. is hard work, and it will take time. And yet, on the consumer side, it is flourishing. So I think that bifurcation is something that we think about a lot. But if Palantir is any indication, and we think it is, you have CEOs and strategic decision makers saying, we've got to do this or we're going to lose our competitive edge out there. And that's why US commercial business was up 123% last quarter, far surpassing anyone's expectations, including our own. There is a strategic imperative now, and it will take time. It will take time to play out in terms of those productivity measures. Individuals are seeing big increases in productivity with these tools. That will percolate into some of the productivity measures. But we think the real productivity gains, the needle moving, it will start within the next year. And already we're still at 2.5%. So that's the starting point. So we're pretty excited about the implications for productivity and real GDP growth, which we think is going to accelerate to levels people cannot imagine now. Longer term, we're seeing that growth, real GDP growth globally, accelerate into the 7 to 8% range because we're in a technology revolution. The last time we were in a technology revolution, growth accelerated globally, real GDP growth, from 0.6% during the 400 years, and Brett did this work, 400 years ended in 1900. For the last 125 years, we've been at 3%. So that was a five-fold increase in the growth rate. And here we are saying 7 to 8%. To us, that's conservative, given the kind of technology revolution we're in. We've never seen anything like it.
Yeah, thank you, Cathie. And I want to highlight the technology and just how that plays out in kind of each of our different specialty products. So a bit different than what we usually do with just Q&A. So let's start with ARKW and Frank. Just how do we capture AI in this product?
Yeah, sure. So ARKW is our next generation internet ETF, and it really has exposure up and down the AI stack. So if you think of the value chain in AI, from infrastructure and chips to the clouds to platform as a service offerings, all the way to end applications, we have exposure in ARKW in particular, kind of across that spectrum. On the infrastructure and chip side, AMD is a top name for us. We think it's an interesting share gain story against NVIDIA, and they have notable customer wins like OpenAI, xAI, and Oracle recently. On the clouds, we think Amazon is particularly interesting because of their tight relationship with Anthropic, who is the second leading independent AI lab behind OpenAI and is scaling their revenue base from 1 billion to 9 billion in ARR in just 1 year. So 9xing $1 billion business. We think that's driving AWS revenue growth, $130 billion run rate business, 20% growing at 20% plus year on year. And then Google is also interesting from a full stack AI angle, where they make their own chips, they have a cloud, and Gemini is the second leading in terms of users AI agent behind ChatGPT. On the platform side, as Cathie already mentioned, we think Palantir is the best positioned company. They've demonstrated an incredible ability to take AI use cases from prototype to production, and we think they're still quite unique in that. But this is an area of the cloud stack, particularly in the software side, where we have more exposure because we have observed and believe this will continue share gains of the platform as a service layer of the stack over time. So there's other companies like Cloudflare and Datadog that are seeing their businesses accelerated by AI, as well as others that we think are interesting from that angle. And then the top of the stack I'd call end applications. We have relatively little exposure to end software applications, kind of like these pure play business apps, because we think that is the most likely area for disruption in the AI age. But I think what's more interesting to us is end kind of convergent examples or implementations of AI. Tesla is the number one name in the portfolio, and I'll let Tasha talk about that later on. And then we have other names like Shopify that we think are interesting from an agentic commerce point of view, which I think is a perfect time to turn it over to Nick to talk about ARKF.
Yeah, happy to talk about ARKF and how we're playing this agentic shopping revolution. I think this applies to both W and F because we do think this idea around purchasing agents is going to be a very secular trend. And we're already starting to see that today. I think we got one of the first real data points from Amazon in this last quarter. Rufus AI, which is their AI shopping assistant embedded into the platform, is expected to add $10 billion in incremental sales. But as Frank mentioned, it's not just Amazon, it's all of these companies that are helping merchants find customers online. And Shopify is a great example of that. That's the number one position in F. It's a high weighted name in W as well. And this company is not only helping merchants build and become better entrepreneurs by enabling AI specific products for them to handle backend automation, they're also helping customers find merchants using AI. So they have their own shopping assistant. They've embedded MCP, which is Model Context Protocol, which is a protocol designed by Anthropic. It's open source. It allows agents like OpenAI and ChatGPT to be able to query better the data that a merchant wants an AI to find. So it's really important to understand that this shopping journey is only getting started. I mentioned the $10 billion figure, but we think that by 2030, roughly 25% of online spend will be facilitated through one of these purchasing agents. So that's roughly $9 trillion in spend. So we have a long runway ahead of us. And we think that there's a number of different companies. I mentioned Amazon, Shopify, but you have Block, Toast, a number of these different companies that are helping merchants better find customers today. They're embedding AI at every layer of the stack. And then the second component to this story, I think, on the consumer end, is advertising. We think that there's going to be a tremendous amount of ad dollars that flow through agentic systems. And there's a number of different companies across both W and F that will benefit from this. Shopify, Amazon, they have ad businesses. They're standing those up. But you also have companies like Meta and a number of different players that are going to use agentic advertising to better target and personalize ads. And we think that this is ultimately going to disrupt the digital ad space and take roughly more than 50% share by 2030 of roughly $1 trillion market opportunity. And so you're talking about many trillions of dollars up for grabs. And I think when you look at where we are today and where we still have to go, this is why I don't think any one of us on this call are concerned that we're in a bubble, because it's just so early into these massive, massive opportunities.
Let's shift gears a little from the website to the multiomics. Shay, do you want to touch on G, please?
Yeah, well, across ARKG portfolio, companies are using AI to speed up drug discovery, patient diagnosis, and treatment. To illustrate this, Recursion uses AI to speed up and optimize drug discovery and development. AbbVie takes a similar data-driven approach using generative AI to develop therapeutic antibodies from scratch and optimize them before testing in a lab setting. In diagnostics, we have a newer name that we've added, Caris Life Sciences, that applies AI tools to analyze integrated DNA, RNA, and protein data from tumors, and this helps doctors identify the cancer's origin and select the most effective treatments. Tempus AI is a healthcare data and AI company that integrates genomic pathology and clinical information with predictive algorithms to support real-time treatment decisions. And in medical devices, we have Butterfly Network that builds AI directly into its handheld ultrasound for image capture and interpretation on a simple smartphone. And I think together these examples in our portfolio show how AI is being applied across the healthcare continuum.
Thank you, Shay. And Tasha for ARKQ.
Yeah, so I hope that the name of this fund says it all, the Autonomous Technology and Robotics Fund. These are many of the embodied AI applications or the physical AI applications. We have autonomous vehicles of all shapes and sizes, companies like Tesla that are leading that charge. We have robotics companies like Teradyne, which has collaborative robots. and the energy platforms that both enable and support these technologies, like batteries and nuclear power companies like BWXT.
And Tasha, if you could continue as well, one more for ARKX, the space fund, please.
So this fund has many of the defense AI applications, companies like Kratos, L3Harris. It has the aerial applications for that physical AI that I mentioned earlier. The satellite communications that are propelled by lower cost launch systems that can support many of these AI applications, companies like Rocket Lab. So again, just more of sort of the aerial defense and the space applications that are involved in AI. I'd say that, I hope you can see the common thread here that AI is really in all of the portfolios.
And if I could just put in a plug here, ARKK, the flagship, touches all of these areas with some of our highest conviction names.
Of course, thank you, Cathie, Tasha, and the rest of the team. Shifting here a little bit, but staying kind of big picture, I want to have this next one for Brett. So there's an interesting article on Bloomberg this week published, and it kind of explained the growing conversation among institutional asset allocators shifting from a very traditional, kind of a more rigid way of allocating their assets with a strategic asset allocation framework, shifting that potentially to a more total portfolio approach. So Brett, can you just briefly explain sort of like what this means and how ARK's products are positioned to potentially earn allocations in this new framework?
Yes, the total portfolio approach basically, the short answer is that it ensures that allocators fund the best opportunities wherever they exist, especially transformational ones, without being constrained by legacy asset allocation categories. And for what it means with regards to ARK's portfolios is that you're looking for idiosyncratic sources of risk that fill gaps in your portfolio. If you're just doing a bucketed, I'm going here, I'm going there, I'm going there. And so our portfolios have innovation beta, so exposures to technologies driving long-term productivity growth. Cathie talked about an acceleration in GDP. That's going to be driven by these technologies, and an incredible amount of wealth is going to be created by that. You might be missing those in a traditional kind of bucketed based approach. ARK's portfolios also have an idiosyncratic growth drivers. Whether or not Tesla robotaxi happens is totally idiosyncratic to anything that's going on with probably nearly anything else in the market. And yet there's a, in our view, severe kind of, the possibility that that happened is severely discounted in the exposure. So if you don't have a meaningful exposure there, you're missing that idiosyncratic risk. Innovation exposure has these secular trends that pierce through the traditional macroeconomic cycle, and as well as high active share, so low overlap with traditional benchmarks. So within a total portfolio approach, these kind of innovation exposures are exactly what probably plugs in more completely compared to kind of the traditional, growth value equity bond approach, where you're probably overlooking innovation strategies because you say, hey, this is like a satellite, I don't know where to fit this. Actually, the idiosyncratic risk, the orthogonal nature of returns, and the differential duration, most benchmarks and portfolios are exposed to near-term cash flow in a profound way. As you know, the market oscillates between focusing on that near term and longer term. And so you need long duration equity type exposure to, complete out a total portfolio approach.
I'll just add something here too. This total portfolio approach, as allocators assess where the risks are, they will be informed more by a strategy like ours, where the risks are in their private allocation. So we think that the rush by private credit and private equity into software as a service, for example, is a mistake. We think software as a service is being disrupted course, there are going to be some winners, a little bit like in retail. Walmart and Costco have accommodated the shift toward online. There will be some winners, but there are going to be a lot of losers, and I think it will become more apparent as asset allocators listen to, at least our point of view, where the disruption in the traditional world is going to take place.
Yeah, I can vividly remember doing this in a prior role. You know, put in a box a strategic asset allocation and looking at ARK in 2017 and just thinking, there's no way you can put this anywhere in those specified boxes. It doesn't work that way. But as kind of a lot of listeners have heard at the beginning, there's a lot of different AI plays here. And with the strategic asset allocation approach, the only way to get that is, you basically buy the Russell 1000 growth. And that doesn't capture all of it that we've been talking about. So I think it's a really important developing conversation. Changing gears a little bit now, more towards just company specific again. We talked briefly on Tesla, but I want to get in robo-taxis. But diving in here, one of the questions we received, Tasha, when and why do you think Tesla will surpass Uber as a ride-hail leader?
Well, our research suggests that actually, even if Tesla were to launch a human-driven ride-hail platform, that they could already be cost competitive with Uber today. And so when we did the research, the cost to drive a Model 3 was roughly 30% less than that of a Toyota Camry. The company also has many advantages from being vertically integrated with finance and insurance that they could undercut even on a human-driven ride-hail platform. But with robotaxis, this advantage should only, this gap should only really widen. That's because we think thanks to higher utilization rates, autonomous vehicles will be much cheaper than their human-driven counterparts, less than half the cost of driving a personal car at scale, and maybe roughly a tenth of the cost of ride-hail today. And I should also mention, we're actually already seeing some evidence that Tesla is undercutting Uber in markets like Austin. It looks like they're probably experimenting with pricing. But again, I want to highlight that sort of structural advantage that they have over Uber as well. And on the robotaxi front, to put this in perspective, today Uber is less than 1% of miles in the US. And because we think robotaxis will have much higher utilization rates, you could take a fleet of roughly, our research suggests that you could take a fleet of roughly 140,000 cars to compete with that mileage. And if you look at Tesla's production, of course, last quarter they produced over 400,000 on the Model 3 and Y platform. But that's not the market for robotaxi. The market for robotaxi is all of urban miles. We think this is, a 2 trillion mile opportunity here. And we think that robotaxis will greatly increase the demand for ride-hail thanks to that lower cost per mile that I mentioned at the beginning. So I would say that these companies really aren't comparable on that front because Tesla has an in-house autonomous platform that Uber does not have.
Thank you, Tasha. So a lot going on in the crypto world right now. It's never a dull day. And I think we talk a lot. This next question came in, it's on Solana, and I think it's because we have a lot of conversations on Bitcoin and Ethereum, and we'll get to that. But this first question is, Lorenzo, what are your recent thoughts on Solana, and why has the price lagged?
Sure. So I think there's a few points. We remain very positive on Solana generally. Number one is, we had a flash crash 2 weeks ago where we had cascading liquidations across the crypto market, and I think that has spooked a lot of investors, right? Cathie mentioned also on the macro side, uncertainty and liquidity crunch, and obviously that affects crypto markets as well, just generally. If you look at the big three, so Bitcoin, ETH, and Sol, for Ethereum, last cycle's all-time high was around $4,800, and for Solana it was around $280 or $90. and both have basically barely broken all-time high, right? With ETH going to 5K, I think for less than a day, and Solana above $300, right? If we've come back basically 40-50% of that. I think we've seen a lot of whale selling across these major assets, right? That happens in these cycles where you have investors, participants that entered 3, 4, 5, or more years ago, and obviously are on heavy kind of unrealized gains, and so you always, to go through these bull markets, you always have to cross this heavy selling from some of the early participants, which is very healthy, right? And then we have like the 4-year cycle, obviously, which is in mind of all the, in the mind of all the investors. This is the fourth cycle. Obviously, crypto always has followed this path of like heavy bear markets and heavy bear and bull markets on a 4-year basis. And so we're getting, we're getting at the end, at least on a time basis, like at the end of this cycle in Q4, and so that I think is also in the mind of a lot of investors, and there is some hedging. I think just like regarding Solana in particular, what we see, some of the fundamentals are down, right? There is a heavy component of just the overall market, but if you see like in Q1 2024 and Q4, Q4 2020 of last year and Q1, basically in those 2 quarters, REV, which is real economic value, so you can think of it as how much the users are willing to pay to use the protocol for Solana, was around like 900 million a quarter, right? So on a run rate basis, Solana was basically, producing around $3 or $4 billion per year annualized, right? And so, it was trading at 30, 40, 50x that, which is, I think for these high growth protocols, acceptable, right? Right now, that has gone down, by it's a quarter of that basically. This quarter, Solana will produce around 200 million, and so just I think there is decline in fundamentals. I think the fourth point that I would mention is also competition, right? So we have Base, the layer twos on Ethereum have been like very competitive. I mean, Base from Coinbase, they've been able to grow a very genuine kind of ecosystem, and they're focused like on high performance. You obviously have Robinhood launching their L2, and so there is like competition on the L2. Monad, which is like a parallelized EVM, is launching this quarter. Mega ETH, which is another high performance L2, is launching also this quarter. And then kind of the elephant in the room is Hyperliquid, right? I think Solana really has gained like the trading ecosystem, right? The consumer and trading ecosystem, and Hyperliquid, which is a purpose-built perpetual futures market, or at least like that's how it started, has really taken a lot of share, right? As basically more than 50% market share in perpetuals, which is really it's really the trading product in crypto. And so I think also in the investors are looking at Hyperliquid and its growth. But I think overall we think Solana has like a very strong roadmap. I think the quality of builders over there is like super strong still, and not comparable. Only Ethereum has that caliber of team, and they're still shipping very fast. So we remain positive, but obviously, there are a few points in the market, and fundamentals have declined.
I'll just add something here, Dan, because it is interesting watching the crypto ecosystem really be a leading indicator when liquidity is ebbing and flowing. I think that's primarily what's going on here. This liquidity squeeze that I mentioned at the beginning, we think is going to end within the next month. And that's probably the most important point. Sure, there are these competitive dynamics between the various L1s and L2s as well. And we're always doing deep dives because there is so much data out there. It is so transparent. But we think the restructuring of the financial ecosystem is also in the first inning.
Yeah, thank you, Cathie. It certainly is, and more and more conversations are happening that way of building financial rails, even from the traditional side. So it's, yeah, definitely feels early. And we are going to stick here on crypto for a bit and get to Bitcoin. And so, Cathie, on X and a few media outlets as well, you teased a Bitcoin price target update. Could perhaps you and David just expand on that a little bit, please?
Yeah, I'll start. It all started because I was on CNBC with Andrew Ross Sorkin and made the comment that compared to our original forecast way back in 2015, 10 years ago, what has happened is that stablecoins are usurping one of the roles we thought that Bitcoin would play, meaning an insurance policy for emerging markets, meaning the individuals in emerging markets whose wealth and purchasing power are destroyed regularly by bad fiscal and monetary policies or by corruption. And that is not happening. However, what is happening at an accelerated rate, interestingly, is the scaling of stablecoins, which I think have scaled to nearly $300 billion. And the other side of that is this has become a natural buyer for U.S. Treasury securities. As China and other countries are diversifying away from the dollar, we've got a big force here, and we think it's only the beginning in the form of stablecoins, which are backed primarily by U.S. Treasury securities. So, David, you might want to take it from here.
Yeah, so basically what we're looking at our model here, just to remind the audience a little bit of what we published earlier in the year. We had 6 main contributors to our Bitcoin price targets. These are institutional investment, which takes as TAM the global market portfolio without gold. Then we have the digital gold, which obviously equates to the gold market cap. We have emerging market safe haven, which equates to emerging market M2 monetary base. We have nation state treasury, corporate treasuries, and what we call Bitcoin on-chain financial services. So a year on after publishing this model, we're focusing on 2 of these buckets that we see as receiving a lot of impact from the markets broadly. One is, as Cathie mentioned, emerging market safe haven, meaning the amount of Bitcoin penetration that could take place in developing nations around the world in order to prevent citizens in those nations from incurring into devaluation or inflation. What we have been noticing is that crypto adoption is wide. It's pretty wide in those nations, but Bitcoin has not taken most of the market share. So going back to a few Chainalysis reports, going back to 2024 and so on, they calculate a global market share adoption in terms of transaction volume for Bitcoin of 20% relative to all other crypto, while leaving stable coins between 40 and 50%, depending on the region. So based on that, we basically modified emerging market safe haven and reduced our assumptions, basically multiplying them by 20%. So we cut them into the 20% into 20% of what they were prior, which results in a decrease in that TAM. And conversely, the other bucket that has had some impact during 2025 is gold market cap, obviously. Gold market cap has increased just as of the time of recording from around 17 trillion to 28 trillion USD. So we run some numbers into how one detracts from the model and the other one contributes to it. On average, it's pretty much netting out, especially for in the case of the bull case, for what we initially modeled out at the end of 2024 and published early 2025.
Yes, and so what I didn't do in that CNBC article was talk about the impact of the increase in the gold price. I said all other things equal. Well, all other things have not been equal. The stable coins have accelerated, taking some of the role away from Bitcoin that we expected at least. But the gold price appreciation has been far greater than we expected. So net, our bull price, which most people focus on that one, really hasn't changed.
Yeah, yeah. So still reiterating long-term bullishness here. Thank you, Cathie and David. This last question here is it's a fun one. It came at a really good time. So last month we had Shay on to discuss upcoming results for CRISPR and their cardiovascular drug target. Well, we've also had some other updates this week as well. So I want to give it to Shay and just Shay, if you could please summarize the results, and we've had a couple this week, and just compare those outcomes to current standards of care.
Sure, absolutely. I'd love to highlight two very recent and compelling updates. So first, we recently had an update for CRISPR Therapeutics in vivo gene editing therapy, meaning the edit happens inside the body. You don't need to extract cells. The therapy targets the gene ANGPTL3, which is a key regulator of triglycerides, a type of fat, and LDL-C, otherwise known as bad cholesterol. And this is important because unlike other standard therapies like statins, which primarily only affect cholesterol levels, suppressing ANGPTL3 lowers both triglycerides and bad cholesterol. So you're tackling two major cardiovascular risk factors at once. So the phase 1 update was in 12 treated patients, so a small number, and the majority of which were already on background standard of care therapy, such as statins. At the highest dose in this treated dose escalation, the average triglyceride reduction was about 55% from baseline, with a max reduction of 84%. For bad cholesterol, the average drop was 49%, and the max reduction was 87%. Importantly, on the safety front, no treatment-related serious adverse events, and no grade 3 or higher elevations in liver enzyme levels. So why is this significant? Well, usually managing high cholesterol and triglycerides requires lifelong daily medications, most commonly statins, and many patients stop taking them. Poor adherence is a major challenge. Some studies have pointed to about half of patients on statins discontinuing treatment after just a year. This leaves millions of people vulnerable. So CRISPR's therapy is a one-and-done approach. It could compress decades of therapy into just a single treatment and has shown early signals that it could be as beneficial or more so than traditional care while reducing treatment burden. And what I think makes these results even extra compelling is that these participants were already on the best available treatments, and yet a single dose of this therapy, CRISPR's therapy, drove an additional 50 to 80% drop in lipid levels. And it shows that even well-managed patients have significant residual risk. So if these results hold up in larger trials, such a gene editing treatment would completely redefine how we treat conditions like heart disease today. And I think a second compelling update I would highlight is Intellia's Therapeutics data for its in vivo gene editing program for hereditary angioedema, or HAE. This is a rare and potentially life-threatening genetic condition that causes recurrent attacks of severe swelling in various parts of the body, such as the throat, abdomen, and limbs. These attacks can occur several times a month without warning, and if severe or involving the airway, a patient will need to seek emergency medical care. So Intellia recently announced long-term follow-up pooled data across phase 1 and 2 for patients that were treated at the same dose level that they brought forward into phase 3. And these patients, 97% or 31 out of 32, were completely attack-free, no longer required prophylactic or preventative treatment, and about 3/4 of these patients had been attack-free for at least 7 months after just a single infusion. On the safety front, there were no grade 3 or greater liver enzyme elevations, and no long-term risks were identified. These results are quite significant. Most patients with HAE need to take prophylactic treatment, so regular injections about every 2 to 4 weeks to reduce attacks, on average around 80 to 85%, meaning patients still experience attacks and must stay on therapy indefinitely. If Intellia's results hold up in the ongoing phase 3 trial, which results will come out in the middle of next year, then Intellia's therapy would represent a step change in standard of care, moving HAE treatment from expensive chronic management to potential one-and-done solution.
Fantastic. Thank you, Shay. Great timing having those this week and on right before the recording. And so with that, that will conclude our webinar today. We'll briefly show performance statistics that can also be found on ark-funds.com. Thank you to everyone who listened. And as always, thank you to the entire ARK team.